morning, everyone. Welcome to this live broadcast of Grand Parade Investments Interim Results. I apologize for the late cancellation of the presentation. However, under the circumstances, we need to be responsible and do our part in mitigating the impact of COVID-19. The last 6 months have been extremely challenging given the poor economic conditions in South Africa. We've experienced negative growth over the last 2 quarters of 2019, triggering a technical recession. Unemployment is extremely low, extremely high. The construction and manufacturing industries are down 5.9% and 1.8% respectively. Despite these setbacks, GPI has delivered a solid set of results, which I'll take you through in this presentation. The outline of the presentation is as follows. We'll go through a governance update, salient features. Mr. Colin Preem will then take you through the financial review. I'll go through an operations and strategic review, followed by closing and a question and answer session. I urge you to post your questions in the comment section on the live webcast. During the period under review, we've seen the retirement of Dr. Hassan Adams and Keshan Pillay. We've appointed 2 non-executive directors, Rosanna Kader and Mondi Nkosi. Alex Abercrombie was appointed as the chairman of the group. Mr. Colin Preem has decided to retire effective of the end of March and will be replaced by Jason October as the CFO and Financial Director effective of the 1st of April. I would like to take this opportunity to thank Mr. Preem for his contribution to the success of the business, as well as his guidance and support. I wish him well in his future endeavors. Despite the challenging conditions, GPI has continued its positive momentum following the June 2019 results, with an impressive set of results for the interim period. Revenue from continuing operations is up 19% from 707 million to 844 million. Gross profit from continuing operations is up 21% from 335 million to 405 million. Group central costs are flat over the period, excluding tax and transaction costs. Net profit after tax improved by 42.8 million from a loss of 36.6 million to a profit of 6.4 million over the period. Earnings per share increased by 9.62 cents. Headline earnings per share increased by 6.6 cents. Overall debt was reduced by 301 million from 565 million to 254 million. Debt to EBITDA is now at 1.4 times. I'll now hand over to Colin Preem to take you through the financial review.
Thank you, Muhsin. Good morning. As Muhsin alluded to earlier, the operating entities continue to be impacted during the period under review by the sustained recession environment. Notwithstanding the aforementioned, we remain committed and continue to drive efficiencies in our efforts to unlock value for all our shareholders. My first slide addresses IFRS 16. During the current financial year, commencing 1 July 2019, the group adopted IFRS 16 and applied the modified retrospective approach without the restating of comparative periods. This resulted in adjustments to EBITDA, depreciation, and finance costs in the current year. The net effect of these adjustments, being 207,000 Rand, is reflected in the slide. This is made up by a positive EBITDA effect of 40.1 million and negative effects of 24.1 million in respect of depreciation and 15.7 million in respect of finance charges. Furthermore, this has resulted in the income statement not being comparable period on period. However, in this part of the presentation, we have attempted to highlight and compare the effects pre-IFRS 16 where relevant. Turning to the group income statement for the year, we note the following. Despite the South African consumer's disposable income being under pressure for most of the period under review, it is encouraging to note the revenue growth of 19% achieved compared to the previous period. Gross profit from continuing operations is up 21% as a result of Burger King's and Grand Food meat plants margin improvement, notwithstanding a negative impact from Mac Brothers. EBITDA, excluding IFRS 16 adjustments, is up 21%, including the effects of IFRS 16, EBITDA increased by 63.9%. This includes a 40.1 million IFRS 16 effect. Also included is an impairment of 38.6 million relating to Mac Brothers goodwill. This write-down is as a result of the decline in the construction and manufacturing industries, as well as a high operating leverage in the business. This ultimately affected the performance of the business negatively. Depreciation increased year on year by 37% due to the effects of IFRS 16, amounting to 24.1 million. However, depreciation is only up by 13.5 million as a result of an extension to the useful lives of assets applied in the latter part of the previous financial year. Finance costs increased by 45% due to a 15.7 million IFRS 16 impact, whilst net profit after tax is up 42.8 million, notwithstanding the impairment previously mentioned and liquidation costs of 5.7 million in respect of Dunkin' Donuts and Baskin-Robbins. The revenue slide reflects the following. Burger King's growth for the period under review continued to impress, up 27%. Encouragingly, average revenue per store increased by 14.7% to 1.175 million, and same-store sales increased by 7.8%. The meat plant, off the back of strong Burger King sales, delivered increased revenue of 20%. Mac Brothers revenue decreased by 17% as a result of the constrained trading environment. Dividend revenue contributions increased by 21.7%, mainly due to increased dividends from Spur. Moving on to the detail pertaining to operating profit or loss, the following is noted. The operating profit line, excluding discontinued operations, increased by 61.8 million versus the previous period. This is partly as a result of a positive IFRS 16 adjustment amounting to 40.1 million and the improved performances of Burger King and the meat plant. The detail I will now provide excludes the effects of IFRS 16. Burger King's operating profit improved by 121% from 21.4 million to 47.4 million as a result of higher revenues and improving margins. The meat plant improved its operating profit by 16% as a result of increased sales. Mac Brothers reported an operating loss for the period, declining from a profit of 3 million to a loss of 7.6 million, hence the impairment of its goodwill. The equity accounted earnings slide talks to our investments in SunWest, which comprise of Grand West Casino and the Table Bay Hotel and Worcester Casino. Our equity accounted earnings reduced by 4%, largely due to a SunSlots 20 million rand credit depreciation adjustment in 2018 relating to the extension of the useful lives of assets. SunWest's contribution decreased by 4% due to declining sales and EBITDA, whilst Worcester Casino improved contributions by 150%. The headline earnings by investment slide reflects an overall increase in headline earnings of 175%. With respect to our food operations, a 230% increase largely as a result of Burger King, which is up by 182%. Spurs up by 7 million and the meat plant up by 153%. This was largely offset by Mac Brothers contributing a loss of 9.3 million, a decrease of 11.2 million on the prior period profit of 1.9 million. The gaming investments are down for the reasons previously mentioned. The group's net central costs, excluding legal, transaction costs, and taxation for the period, amounted to 17.3 million, which is in line, albeit slightly lower, than the central costs of 17.5 million for the 2018 period. Finance costs decreased as a result of the repayment of debt, whilst discontinued operations improved by 77% as a result of the closure of poor-performing businesses. My final slide reflects a debt-to-equity ratio of 12%, a significant decrease as a result of the settlement of 301 million rands worth of preference shares relating to Spur and our gaming assets. Debt to EBITDA has also decreased significantly from 5.23 times for the 2018 period to 1.45 times for the period under review. Interest times cover improved from 3.38 times to 3.7 times, which is an 11% improvement. Excuse me. In concluding, my part of the presentation, I would like to extend my thanks to the Chairman of the Board, the GPI board members and the Executive Management Committee, Hussein, Jason, Tashni, for their support, the GPI group finance teams and the finance teams of our subsidiaries for their commitment and assistance, which has resulted in us being able to deliver this interim set of results this morning. I thank you. Hussein.
Thank you, Mr. Prim. I would give you a hug, but under the circumstances, maybe not. Our strategic initiatives have remained unchanged over the last year. Our focus has still been to reduce debt, improve efficiency and profitability. We continue to look at ways of restructuring the group to reduce central costs. Over the period, central costs have remained flat. Over the period under review, we've completed the sale of the Spur BE portion of shares and reduced debt by 300 million, strengthening our balance sheet. We have continued to aggressively market our properties and will hopefully conclude the sale of these properties within the next 12 months. Our continuous efforts to improve the profitability of our operational businesses has achieved the desired results. BKSA improving headline earnings contribution by 182%. Grand Foods Meat Plant increasing headline earnings contribution by 156%. Both these businesses are now contributing positively to headline earnings. Mac Brothers, on the other hand, has had a difficult 6 months and had a loss contribution of 9.6 million rand over the period. Over the last year, we've opened 6 new Burger King restaurants. Over the period, we've also closed 1 unprofitable Burger King restaurant. We are also now nearing completion the liquidation of Dunkin' Donuts and Baskin Robbins. The first liquidation and distribution accounts have been lodged with the masters, and we now await final distribution. Overall, group central costs increased by 16% from 17.5 million to 20.2 million. This includes transaction costs associated with the Sun Slots transaction. If this is backed out, comparable transaction costs were flat compared to the prior period. Over the last 6 months, we've completed the decentralization of shared services by moving resources into our operational businesses, and we should see further savings moving forward. Burger King has once again had a phenomenal 6 months. The marketing team did an incredible job in driving sales. Revenue for the period is up 27% with an impressive like-for-like sales of 7.8%. In a depressed economy, this is a fantastic achievement. Revenue for the period is 630 million. Over the last year, we've opened 6 new restaurants. EBITDA pre-IFRS 16 increased by 2.3 times to 47 million rand. This is the second consecutive period that the business has contributed positively to HEPS, BKSA contributing 7.8 million to headline earnings. Grand Foods Meat Plant has had decent growth off the back of higher demand in Burger King, in particular Burger King Whoppers. The plant continues to supply Spur with halal burger patties. Production volumes increased by 22.5% from 1,300 tons to 1,600 tons over the period. Capacity utilization is now at 45%. Revenue increased by 17.3% from 81 million rand to 96 million rand. EBITDA for the period is up 28% from 3.9 million to 5 million. Net profit after tax is up 218% from 1 million to 2.2 million. Mac Brothers has had a difficult 6 months affected by the contraction in the construction industry and manufacturing industry and a lower demand for catering equipment. Revenue for the period is down 21% compared to the prior period. This is predominantly due to a decrease in local demand. Africa sales have also suffered during the period as a few large projects were delayed. Gross profit for the period is down 32% due to a decrease in revenue as well as a decrease in gross margins from 31% to 27% as a result of the reduction in manufactured goods, which have higher margins compared to imported goods. The decline in Africa sales also had an effect on gross margins. The focus over the last 6 months has been to stabilize the business by reducing operational expenditure, which is down 2% compared to the prior period. EBITDA for the period is down 11.3 million from a profit of 4.9 million to a loss of 6.4 million in the current period. The focus of the management team over the next 6 months is to control expenditure and reduce losses during the challenging period that lies ahead. Last year, we entered into an agreement to sell 30% of our equity in Sun Slots to Sun International. The deal was approved by GPI shareholders in December last year and is pending Gaming Board approval, which has been delayed. To accommodate the delay, we have mutually agreed to extend the long stop date to the end of June. We anticipate Gaming Board approval before then. In February 2020, we entered into an agreement to sell our equity in Burger King South Africa and Grand Foods Meat Plant. Enterprise value for BKSA is 670 million, which is an 8 times forward EBITDA. Enterprise value for Grand Foods Meat Plant is 27 million rand, which is 3 times forward EBITDA. We are currently negotiating a share repurchase agreement, which we hope to conclude in April 2020, with the deal closing in June 2020 following our special general meeting. The first tranche payment is of 75% of BKSA equity value and 50% of Grand Foods Meat Plant equity value will be paid on closing in June 2020. The second tranche payment will be made in December 2020, 3 months after audited financials have been completed. And the last tranche payment will be made 24 months after closing. In considering the Burger King deal, the board deliberated on several strategic options for GPI. The first being to reject the offer and hold on to Burger King, changing the focus of the business from an investment holding company into an operations business, growing the foods business as initially intended. In doing so, we investigated the 5-year plan of the business and the future value of Burger King, taking into consideration that additional capital would have to be invested over and above the cash generated in the business. We then discounted the future value, less the additional capital, and compared this to the current offer. Our calculations showed that we would break even on our current offer in 3 years' time, indicating that the current offer is attractive based on the high execution risk in the business. The second option we investigated was to retain 25%, a significant minority, in Burger King, and shift back to being an investment holding company, with 15% of SunWest and 25% of BKSA being the major investments. This did not present a very compelling case, as the portfolio of investments would be weighted towards low control with high access points. An investment holding company of this nature would invariably trade at a significant discount to the value of its underlying assets. The third option we considered was to unlock value through a controlled sale of assets and a return of capital to shareholders. GPI trades at a significant discount, which varies between 35% and 45%. The controlled sale of assets would allow us to unlock this discount in a relatively short period of time, which will be beneficial for all shareholders. In considering these options, the board felt that the best way forward for GPI would be a value unlock through a controlled sale of assets. The sale of Sun Slots and Burger King are the first steps in implementing the strategy. The proceeds from the sale of these assets will be first used to reduce debt and then returned to shareholders in the form of a special dividend. Unfortunately, the impact of the coronavirus has escalated in South Africa and is a risk to the group in implementing the preferred strategy. Fortunately for us, we've managed to reduce our gearing substantially, and we are in a strong position to manage any negative impact on the group. Although we've seen an impact on Burger King over the last few days, it's still too early to quantify the true impact that this will have. We have, however, adopted our operations to deal with the effects of COVID-19. The team has been working around the clock to switch on alternative delivery mediums while channeling spend towards guest confidence. Our restaurants have adopted the highest precautionary measures to ensure that our establishments are safe. We are also in the process of implementing curbside delivery, which will allow customers to click and collect without entering the store and with limited contact. I thank you for your time dialing into this presentation, and we will now take questions on the presentation. Please allow us a couple of minutes just to regroup and consolidate the questions, and then we'll respond to the questions. I thank you for your time. Oh. For a couple of minutes for the questions to come through. Should we maybe ask to see if they can send it through to our WhatsApp? Wait a minute or so. It seems that there's no questions that have come through. However, we have arranged a series of calls with investors, and if you do require us to clarify anything, please reach out to Investor Relations, and we'll be in contact, either setting up a call to discuss. I thank you again for your time and pray that you and your families are safe during this period. Thank you very much.